Hey everyone, welcome back to the MLB Players Draft podcast series. I'm your host, Josh McAllister. I'm a CPA and a certified financial planner, and I'm joined today by my co-host, Will McGuffey, who's an attorney and certified financial planner himself. Will, thanks for being on the show.
Appreciate it, Josh. As we're here to talk about everybody's favorite subject, taxes.
It might be my favorite subject,
but nobody's favorite subject.
But yeah, nobody's, yes.
But more specifically, we're here to talk about the difference between tax planning and tax filing, and really get down to a discussion about how those two are different. So I guess the way to start this conversation off is, how do most people handle their taxes?
Yeah, I love this question because if people understood this, I actually do believe that a lot of the tax planning that is missed wouldn't get missed. Yeah. So let's just talk about how people interact with their taxes. They get a bunch of documents in January, February, and March that they really don't know what they are. They're the W-2s, 1099s, 1098s, 1095s, and you're just sitting there going like, this is really confusing. Let me just hand this over to my CPA and he'll prepare my tax return. If he has any questions, maybe he'll reach out. Yeah. That's how people interact with their taxes. And your CPA might tell you you're a good client if you're just really organized, meaning that you have all those documents and you can easily give them to prepare your taxes. And then once you get your tax return back, what is your judge of success? How big is your refund?
Did I get a refund?
Did I get a refund?
If I didn't, you did a bad job.
That's right. And my CPA is, my guy got to be a bigger refund, and therefore he deserves my business. Well, I'm here to tell you that's the worst bar of success to measure him against.
Well, you're saying that's the worst bar of success. How should we actually measure our success, and how do we know if our CPA is actually doing a good job for us?
Yeah, like if we're proactively planning before we get those documents. So really, if we're actually planning before 12/31 of that year. So for example, all your tax planning for 2022 should have happened before December 31st. Yeah. That's actually like a very uncommon thing to say, but the most important date in the tax world is not 4/15 when the deadline to file your return. It's 12/31.
So it's the previous year, end of year.
Because here, let's just go back to the refund thing really, really quick. All that is just an interest-free loan to the federal government. Yeah. That's what you're doing. Yeah. You're not getting anything back when you get a refund.
That money's not in your account. You're not able to utilize it in some other manner. And what you're talking about kind of in that first scenario was, that's just tax filing. Yeah. That's tax preparation. There's no planning going on. Now, when we talk about planning, can you break that down a little bit and tell us, what is tax planning? How is it accomplished? And then also kind of break down and say, hey, during tax planning, these are the things that you can actually do that are missed if all you're doing is tax filing.
Yeah, I think we'll get to some handful of tactical things that are pertinent to really the MLB player and the draft player as well. But really, tax planning, as rudimentary or elementary as this sounds, you're planning to get every number on those tax documents that you may not understand, but that you know are going to be there so that the CPA can file the return accordingly. Yeah. You should actually plan to, at a minimum, break even, meaning that you're not getting a refund or issuing a payment, or pay as a large amount of money possible when you file your return.
But I thought that was a bad thing.
I know, it sounds weird, but more money in your pocket means that you put that money to work throughout the entire year, not what you lent to the government that they are then returning back to you.
So when you sit there and you say, hey, I'm going to put this money to work, what do you mean when you say, hey, I'm going to put this money to work? And then how do I actually do it? Am I sitting there, holding back money that I should be paying? Do I owe penalties? Do I owe interest? Or is this all allowable?
Yeah, I think that's a great segue into just one of our 5 things that we can talk about even from the tax planning side. One thing that you just mentioned is hey, how do we even pay taxes? Yeah. There's something called safe harbor tax planning that we can even just start with. That's basically you just determining when it's most advantageous for you to pay your tax liability. Everybody has a tax liability. Yeah. That's not when you go hey, I'm getting money back from the government. No, you have a tax liability, and there's certain rules that allow you to avoid penalties and interest. So what happens is players or people have spikes in income from year to year. The government says, hey, you can't just stroke a check when you file your taxes every single year because they have to fund all their projects throughout the year. Yeah, like they have to make sure roads are paved, that lights work. That makes sense. That's good, actually. Opportunity happens when you have big spikes in income. You can actually pay more when you file your tax return. So let's say a $4 million bonus, you have $1 million tax liability, you had no income last year, you can withhold or hold back as much of that money as possible, invest that money throughout the year in something safe. Don't get crazy with it.
Yeah.
But you can earn 2 to 3% interest right now. That's $20,000 to you just by time, figuring out when to pay your taxes.
And I think what you said right there to help understand again the difference between withholdings. Withholdings are when it's held out of your paycheck by somebody else versus you controlling it. And it's not a withholding, but you're actually holding it yourself and doing something with it that makes a positive income for you, whether it's 2 to 3%. That's still $20,000 or $30,000, correct?
Correct.
Okay. What else, I guess, when you talk about what is normally missed? Like what do you see missed by people that just file taxes versus people that actually do tax planning the year in advance?
Yeah. Let's start with the big one.
Yeah.
Residency. It's the hot topic that everybody wants to make sure they hit on. It's not known, though, that a draft player's bonus is not looked at by the IRS as a true signing bonus. So the IRS says a signing bonus is legitimately like, I signed my name, I've then done my duty, and I can now receive compensation. The IRS doesn't look at that like that because in that contract, there's something called the recoupment clause or the abandonment clause. All those are synonymous. That basically says the player has to play 5 years. He can't retire. It's basically the team's protection that says, hey, I'm going to pay you $5 million. And then the kid just says, hey, I'm out. I'm going to bounce and take my $5 million.
They can recoup it.
They can recoup it back. And so then the IRS says that's not a signing bonus. That's W-2 wages, which the important thing there in terms of residency, you pay where you reside everywhere, like in any standpoint, but making that W-2 wages also where you play.
Yeah.
So residency actually may not matter depending upon the planning that you do. What I mean by that, let's say you live in Georgia and you move to Florida or to Tennessee or to Texas, where there's these 0% state income tax states, and you earn your bonus and you're in Maryland when it's paid out. Residency doesn't matter.
Yeah.
You're going to end up paying to Maryland unless you proactively plan, and we've done this and worked with agents in the past on the amount that's paid, maybe taking that clause out, which is difficult to do.
That's what I was going to ask, that you can the language matters, so you can come in and if the language is in there, you need to be aware of it and plan around the language being there, but also you can plan to have that language taken out. And I think we're going to go into more detail on the differences in another segment, but those are just things that we should plan for and look at in the contract. What are some other things that are commonly missed? Is there 401k? Is there IRAs? What are some other things that I should plan now instead of when I file, or I might miss out if I don't do it now?
You should ask your financial team, does the team that drafted me, do they have a minor league 401k?
Yeah.
You should ask that. And that's going to
do all teams have minor league 401ks?
No, about half of them do, half of them don't. And the ones that do have it's different rules. You can contribute on day one, you can contribute on a year later, but you need to know those rules based on what's available to you.
And once again, that's proactive planning.
Proactive planning.
Before you sign your contract, understanding, versus just, hey, this is what happened.
Yep.
Okay.
Next one is thinking about your streams of income. We touched on this in a different episode, but you need to understand that you have retirement plans available to you based on your streams of income, which is your 1099 income.
And that's your endorsements, your autographs, things of that nature.
Yes. Okay. You can set up a 401k plan, something called an individual 401k or solo 401k for that stream of income, which all the money that you're available to put in that account is tax deductible to you in the year that you make that contribution. Okay.
Well, let's just let's get a tangible example. Let's say that, we mentioned $5 million and you mentioned Georgia to Tennessee. So let's go $5 million, Georgia resident moving to Tennessee, to Florida, to Texas, $300,000 in endorsement income. Just walk through the planning process for me. Right now, I'm the player. What do I need to be aware of from amounts to timelines, and how should I look at this?
Yep. First thing I would do with you is we tackle residency.
Yeah.
So want to make sure that where you reside, you like if you choose to move to a 0% state income tax state, we do so. We have residency checklists for Tennessee, for Texas, for Florida, Washington.
And that's to do it properly. It's back to the tax avoidance.
Correct.
Legal versus tax evasion illegal.
And that you actually like live there. But what that equates to, if we tackle that first, it's about $300,000 to you. That's a big deal.
That's money in your pocket that otherwise would be going to a state government.
Correct.
Okay.
Correct. The next conversation we would have is like, let's set up your minor league 401k plan.
Yeah.
And if it depending upon the rules is work with your agent to structure your tax bonus to maybe be paid out in 1 year's time if you have to wait a year to be able to contribute to it.
Move some dates around.
Correct. Move some small dollars. Like
Yeah.
the max you can contribute to that account is $20,500 as an employee. So just basically push out one of your payments for $20,500 to 1 year
if that's the rule
if
in
that's
place.
available to you, but just like don't leave that on the table because translation again, that's $9,000 in taxes avoided for
Plus you've got an extra $20,500 in a deferred account for your retirement.
Correct.
What else? We talked about the 1099 income. What are some things that I can look to around the 1099 income?
Yeah, it goes back to that individual 401k. This is the one that we see missed. In working here at AWM, I've never seen a player or a different family that's come over to work with us that already set this account up. Yeah. And I'm like, it does kind of bamboozle me sometimes as to why it's always missed. But basically, you set up an individual 401k account. The rule is you have to do it by 12/31. So
and this
December
is, once
31st.
again, this is for your 1099 for that those activities that are away from your club.
Yep. And as long as you set it up by December 31st, you can contribute the maximum amount to this account.
Yeah.
Why did we choose $300,000 of endorsement income? That allows you to contribute the maximum amount because it is predicated on the amount you earn.
Actually earn. Okay.
Right? Like the IRS has set rules, which the max you can contribute is $61,000. Again, translation, this is $25,000 available to you in tax avoidance. And let me just pause right there. We say at times that these are cold hard facts.
Yeah.
That are these numbers are not hey, maybe this can happen or hopefully we can get it past the government. No, this $300,000 of residency in this scenario, that's real. It matters.
This is the tax code.
Yeah.
It's legal. You can put it on paper and stand by it.
$25,000 available to you from the 1099 endorsement income with the individual 401k. Boom.
Yeah.
Matters.
Well, let's one thing I want to talk about is as a player that's drafted, you have these huge spikes in income.
Oh yeah.
So I get drafted and let's say I sign for $5 million, 2.5 in the first year, 2.5 in the second year. Third year, I'm back to making, let's just call it $20,000.
Almost nothing, right?
What is an opportunity based on those spikes, peaks and valleys of earnings that a professional baseball player has? Is there any opportunity there for me to take advantage of that?
Yeah, I think let's just real quick just say, hey, 401k, those accounts, those are all tax deferred. Or I like to use the term tax delayed, meaning that you don't pay the taxes on them now, you pay them in the future when you pull the money out.
Yeah.
It's different than a tax-free account like a Roth IRA. Okay. Well, by setting up those 401k accounts in the years that you did, that individual 401k, I mean, after year two, we're talking with, $122,000 of 2 years worth of 61k of contributions.
Yeah.
You can, since you're in a low tax bracket year, you can do something called a Roth conversion.
Yeah.
If you think about what this is where you can lock in your investment rate of return through tax arbitrage. I'll show you.
So it's a big word.
Arbitrage. It is. But you defer at 40%. That's year one of your bonus, meaning that you contributed to that account and you deferred.
So you kept $24,000, $25,000 in my pocket.
Yep. Because you're in the highest tax bracket. Do the same thing in year two. Another $24,000, $25,000 in your pocket.
Yeah.
Okay. In year three, you're now at the 12% marginal tax bracket. You can do a Roth conversion, convert all that money into a Roth IRA, and thus you just created but
at that point I owe money back, so I'm paying 12%, but let's say it's $14,000.
Yeah.
But I already netted out 50, so I'm actually because I saved that 25 each year in my pocket.
You locked in, on the marginal tax rates, 28% rate of return.
Yeah. And that's free money. That's just by planning understanding your career path, understanding the peaks and valleys that are going to happen for a professional baseball player.
Yep.
That makes a lot of sense. Well, Josh, really, really appreciate, this conversation. Is there anything, lasting, one last impactful, tip that you want to give, or something that these families should think about?
Yeah, I think the last thing I would say is more on the intangible side of things. I think you have to understand that proactive planning is an ongoing process throughout the year. It doesn't just happen, okay, well, now is the day that we're going to do tax planning. And especially as it relates to the contract negotiation, your financial team should be working in lockstep with your agent on this. This is something that we handle and like work with numerous players to, like, if you want to have the maximum output from your bonus, it happens in communication constantly.
Well, it's planning, right?
It's planning. It's actually planning, not checking the box and regurgitating numbers.
Yeah, and thank you for your time. And as always, reach out if you have any questions. Our contact information is in the show notes. Until then, stay humble, make an impact, and always be a pro.